Yeah, I'm losing my
Trading
edge.
metals in the short term is a lot more fun exercise than what Pete and I did over the weekend. And it's interesting because what we're going to talk about today, Pete, intraday scalping and how we view opportunity in markets in the intraday has been especially relevant for metals for the first few weeks of 2021. But isn't this just how it works? Today, metal is the least interesting asset class of all of them. It's really frustrating.
Absolutely. It was quiet last night. It was quiet today. Very interesting inside days. Even in the non-precious metals or base metals, copper very quiet, silver very quiet, gold. It was interesting. A lot of volatility marked out of there. I think we're going to start to lose our SI bearish trades at some point. There's still enough in there to get some stuff done. But it's getting movement's getting a little bare in there in the precious metals. So, but let's talk about some tradable opportunities.
Yeah,
see, this is what we look for, an established high. We don't know if this is the established high or the next print's going to be 95, but established high and the market finding a reasonable range, which is 85, not down to 60, but what's a reasonable scalping range?
Yeah, and I'm glad that you bring up that longer term mentality, like volatility falling off a little bit. And that has to do with the fact that this market has been range bound for the last few months. And that causes volatility to drop off. Usually volatility or fear in a market, which is often synonymous with opportunity for a lot of medium or longer term traders, that only comes in when markets are exploring new territories. And we saw that new territory in March of 2020 as the pandemic news was starting to circulate. And then also in the fall of 2020, as metals made new highs, we saw gold at an all-time high going back to like the 80s and 90s. I don't even know when. And that's when you get that juiced volatility. Those option prices start to rise. Longer or medium-term traders are seeing more opportunity. But we like to come in, Pete, when this market sees some range boundedness, especially when it's paired with the fact that this market here, amid this stretch of finding its range and not really breaking out of that range, has exhibited some large intraday moves. And like I joked about today, unfortunately, not one of those days, but as recent as last Friday, and we'll get into that day in a second here, a lot of dollar plus moves, which in the small exchange markets, Pete, are pretty big days.
Yeah, that's what we're looking for is, you know what? A year ago or 6 months ago to a year ago when we started and we're finishing up building products, we were looking at products between $45 and $70 or 45 and 70 ticks. So yeah, with the expanded rate, this is what's great. You're not dealing with a $3,000 move in gold. You're getting an extra 35 or 40 ticks. And the dramatic amount of increase in travel back and forth, those unique prints that Frank often talks about, which is such an interesting fact and a powerful tool for intraday scalpers in terms of opportunity. So yeah, the expansion of these ranges there's no secret sauce behind this. It's just a function of the way the underlyings are moving, but it's certainly presenting us with a lot of opportunity.
Yeah, because you nailed it there, Pete. All of the small exchange products are designed to move around $50 to $100 a day, which would, as you're looking at this this measurement here, 50 cents to a full dollar. And you can see with the one standard deviation range in SPRE, the small metals futures, one, at $1.10, that's the largest of the smalls currently. And two, that one standard deviation range being farther than $1, where we designed these products to move, tells you that it's pretty volatile, even for settling into, and that's what's funny is going back to this slide here, settling into this range for the last, this is almost half of a year, Pete, where they're in a $10 range, but on a daily basis, the range is more than $1. That is really intriguing to me that over, 6 months, let's say there's, 22 to 24 trading days in a month. There's, over 100 trading days in that mix, Pete, and they've all stayed within that $10 range in the long or medium term. But in the short term, they're moving about $1 a day. That's really interesting, and it makes for a great short-term trade for scalpers, short-term speculators, whatever you want to call it. Especially, you look at Friday here, Pete, and this small exchange market does not trade 23 hours a day yet, working towards that. But opens here around 7 a.m. Central Time, and you can see that SPRE closed the day before at 76.47. Let's call it 76 and a half. Opens the following morning below $75, puts in a bottom of around 74.75. So it opens $1.50 lower, extends a little bit on that, and then comes all the way back, Pete, to close within just $1 lower of the prior day's close there. And this is all, a lot of numbers to throw at you. So hopefully, we'll sit with this slide for a second and Pete can give his take. But this is all to say that this market moved more than $1.50 to the downside in the morning and then bounced back, recouped about half of those losses in a matter of just one trading day there. Once again, this is a market that has not moved outside of a $10 range in the long term, but in this day alone moved almost $2 and then came all the way back. That's a lot of opportunity.
Yeah, absolutely. And that's what we're looking for, is that back and forth in a tradable. I mean, we've run through so many interesting opportunities of giving ourselves at highs. This is what I love. Giving ourselves opportunities to extend duration, stay in a trade longer, reduce cost basis with trades at the highs and the lows, trading extremes. Now here is trading back and forth. And you would think, well, there's no high or low to be had. Actually, within a range like that, there's a lot of opportunity to be had in the back and forth. Or are we always, we know once in a while we're going to get caught with an expansion of the range, either a little bit of capitulation to the downside or follow through to the upside. But here, just in a single day, the back and forth in terms of opportunity is great. Now we'll take the expanded range, and also you can just see here from looking at this, Frank. And I'm glad you brought up, the full day. The amount of unique back and forth is really, and it's not like once you go to 10 o'clock, it's not like you're looking to trade every one of those 20-point back and forth. But if you're looking for opportunity around the range, lots of good spots for location. So there certainly is, I think what we're talking about here is, an expanded range. And I love the idea of you looking at, and I've never looked at markets this way. What is the range you're giving me versus the range they've covered for the last 6 months? And looking at that as being a rich opportunity for trading back and forth. It's a good way, it's a good context to put around it, because oftentimes we'll see products compress much more dramatically than we've done to this point. And we keep trying to make a story or a reason that we're entitled to more range than we get. Bonds being a classic example of that. But this is a great piece of context.
Yeah, and I think that on that note, quickly, going back to this, this first slide here, a lot of people who are used to trading, on a 1 month or 6 month or full year basis, making speculations for that kind of time frame would say, oh, well, since August of 2020, there's been nothing to do here because it's been in this $10 range. There's been no new highs or new lows, but we view things quite the opposite. This is, in that headspace of trading very often, trading small with these small exchange products, and not just making one big bet, saying, oh, gold is going back to all-time highs, or gold is going to fall through the floor and go back to all-time lows. We don't like that as much as, and look at all of the short-term opportunity here. And another point that you nailed there, Pete, that I want to expand on here is the fact that I've always borrowed this from my former risk manager, Gene, a really good guy at the Board of Trade, and he always likened it to the rubber band effect. And you and I have talked a lot about this, where right here we've got the rubber band at $1.10 on either side. And that rubber band, what you're trading when you're trading mean reversion or whatever you want to call it, is that rubber band is going to expand and then come back. And that's what you saw right here, is that expansion and then coming back. And here I even highlighted where the 1 standard deviation range was compared to the Thursday close here in the Friday session. It was about $75.40. Came all the way below that and then closed inside of that range. That's the rubber band expanding and then coming back. And yeah, Pete, every once in a while that rubber band breaks, right? And that's just a matter of having the mechanics to say, okay, the market opened here with the rubber band expanding. It was the range was supposed to be 75.40. It opened all the way down at 75. I bought these 75s or hopefully even lower. And if the next trade is 74.5 or 74 even, then the rubber band has broken in my trade. I need to get out for that loss. And that's the end of it, because what we're seeing with these probabilities, the 68% or the 95% with the 2 standard deviation, is if as long as I don't let that rubber band break at such a catastrophic manner, then I'm going to be good with those odds in my favor. And that's what we saw here on Friday.
Right. And I think, Frankie, you hit on a great point, and the rubber band's a perfect analogy. And I don't want to say that you every trade you do within taking advantage of the rubber band, you expect the rubber band to break, because that almost seems a little bit paralytic. But that's where your mechanics come in. If you set up for the fact that eventually it will break and you'll be wrong. But if you prepared for that, don't expect that. But if you prepare for that, that way you manage those outliers, and you get the whole point of the rubber band for you and I is to have a larger number of occurrences, be able to take more out of a market that is trading in a wide range, but in a range, and not have to pick the low and high. So it's an important part of those mechanics that you set up right after your strategy around management are critically important every time. And I don't want to think like every trade I put on, I'm living in fear of, quote unquote, the rubber band breaking. I'm just cognizant of it. It's part of my decision making. So I mention it in a measured way. I don't want it to consume like, well, I can't put it on because this is the time it breaks. They never do anything. But just that fact, and you know what? 68 and 95 are probabilities. So 68 gives us 32% of the time out on either side. We know that. We saw that at almost, what was our biggest move last week or the week before? $3.80, right?
It was about $3, yeah.
Yeah. So, you know what? We have a propensity to do that. We know that. So let's just, we trade and create mechanics accordingly. But I think this, in a nutshell, is really interesting. And for me, while there's not a trade necessarily to be had in this, all of the opportunity still exists in this, in our rubber band range. And it's a matter of just, you know what? This is why we like to have distinct asset classes, so we can move from opportunity to opportunity. This doesn't come off the plate because for 2 days it hasn't given you anything.
No, yeah, you're absolutely right. And it is funny. We saw this great trade on Friday, and now it's Monday, and this metals market is not moving. But this is directly applicable to those other asset classes, like you're saying. And that's why, Small Exchange has products across these different asset classes. Why, as futures traders, we advocate for having, equities and interest rates and foreign exchange, everything on your board. Because today, equities are moving around. And in that similar fashion, you saw that rubber band expand. We'll get to it on the next segment. We saw that NASDAQ, that sticks, SM75, whatever you're trading, expand and then come back. And we'll see where the next trade is, but that's that rubber band. And to your point, Pete, and this is where we'll close out here. Every once in a while, that rubber band does break. You see the big move here in March of 2020. You see the big move here in late summer or the fall of 2020. And now we've got the range boundedness. And there's going to be these big moves. Like Pete said, $3 was a big move, probably the biggest move of the year so far. And we saw, I think, at one point last year, a $6 or $7 move in these SPRE futures. And that's a big move. But here's the thing. Those mechanics that we've talked about in past episodes, go check them out, of small stakes. Those mechanics let you take that rubber band breaking and dull it in your mind so that you aren't afraid of it. Because if you do get that $3 move or that big $7 move that we got last year at one point, your mechanics say, well, I'm only going to be out 50 or 100 ticks on this, and that's the end of it. And so you take, a $50 or $100 loser as opposed to that $200, $300, $400 loser. But so it's a matter of putting this opportunity of the short-term trading with those mechanics that we've talked about in the past. And just a last little fun note here. Why are we looking at metals specifically? Because we've seen actually in this asset class some of the biggest differences between the intraday high and low and where the market settles. And you can see here this little fun fact that we'll leave you with. There's been more than 50 cents of difference on average in the last month between where this market closed and where it put in a high and low there. And so what does that mean to me? Well, with that rubber band at $1.10, we've seen on average a higher low that's been at about $1.60 or further. That's where all that opportunity comes in, is that nice 50 cents, almost 50% of the actual movement in this market in terms of where it's putting in a high and low in the short term. So that's trading metals in the short term. And yeah, like you said,
Good
Pete,
set of metrics,
directly,
Nick. Yeah, I like.
and it's applicable to all of our different asset classes.